Barb, what are you doing with right now? Are you buying or staying pat?
You know, I'm pretty fully invested. And what I've been doing is making changes around the edges. You know, today, for instance, I was adding a bit of GM. I was adding more Boeing and just trimming from some of the high flyers, so still maintaining my positions. But I do think right now you're going to have a cyclical bent, although I do think the barbell approach has worked and will continue to work. But right now, I think the economy is opening much quicker than anybody thought. And so I think there's a bit more to go here. But I think we're getting near the end, and the market is a great discounting mechanism. So the next step, I think, will be to trim back even farther, but not just yet.
Yeah, there's some suggestion that we're in for, I don't know whether it's a month or a couple of months of, maybe choppy trade, trying to figure out where we're going, a little direction. We've come a long way. A lot's got to be baked in. You still have tax policy perhaps to worry about.
No, exactly. And I think you've also got to have more inflation fights along the way. For now, people are the Treasury, the 10-year Treasury has backed off, stabilized, but that may be temporary as we get more numbers in. And every data point we're getting in, whether it's employment, consumer confidence, the ISM numbers, are showing this economy is going to be running pretty hot. And we're also heading into earnings season. And the revisions have been pretty widely spread and up. But I think we're going to see more on the upside. So I think that's what's going to drive the market for the next, a month or two. But then I think into that, you should be taking some profits.
Hey, Mike, if you look at what's working today, utilities are at the top of the market. Consumer staples, real estate, they're all higher, which follows the move lower in Treasury yields. Very firm today and a flattening of the curve. What's driving that?
Well, there's been a little bit of a kind of subtle move toward quality, toward defensive, toward stability over the last little while. I mean, not so much a dramatic flight away from cyclical stuff, but you see financials have 2 days of relative underperformance and give back. I think that part of it is just like the natural choreography of these rotations that have supported the market. Part of it is yields have backed off. We are at a moment when we have to ask if just exactly how much of the cyclical upturn has already been priced in. I keep pointing out that when you see these super hot numbers like for the manufacturing indexes and even the services economy, usually it's not as good as it gets, but it usually means that the market has sort of figured that out. We have to see it come through with earnings.
The job openings was super strong
very,
as well.
Very strong as well. Absolutely. And you see the market saying, yeah, exactly. That's what we've been doing for the last few months is pricing this in.
Well, I mean, Pisani was throwing around the word Goldilocks earlier.
Sure.
Mike, if you look at the environment you said, it's not like yields are running away. Vaccine news continues to be fantastic.
Yeah.
Economic news, blowout.
Credit's very supportive. I think the only problem is everyone sees it in front of them. Nobody's actually saying those things are not true or not going to happen for the rest of this year with this economic boom. I think what you do have is, tactically speaking, you're up 80% in a year. Usually 1 year after one of these major lows, you do get some sideways give back. And I think that the risk reward has changed just because of how far the market has come in a short period of time.
Shepard Smith here. Thanks for watching CNBC on YouTube.